Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Massimo Butti, head of equity at SDX, the digital asset exchange and central securities depositories owned by the SIX Swiss Exchange and Post-Trade Services Group. Thanks for joining us, Massimo.
Thank you very much, Dominic.
Now, your background is in exchange-traded derivatives. How do you think that's colored your approach to digital securities?
More than colored, I think that I can draw some parallels between the world of derivatives and the world of digital securities. One is clearly innovation. Derivatives have been at the forefront of financial innovation for the best part of 20 years. And that has given me a certain awareness of how to deal and how to cope sometimes with innovation, but also how to always look at the development of products and services on a specific asset class or on a specific market as a continuous innovation process. And I think that is very useful because that is the way that basically DLT and DLT-based technologies operate, these continuous cycles of rapid development and change. I think that the other thing is that innovation in derivatives has always been seen as a way to improve efficiency, and I don't want to be reductive, but we always saw efficiency in expressed into areas better operations, better risk management, improved margins. And I think that looking at the innovation space in the DLT world, that is also the same guiding principle.
Well, as you say, in the exchange-traded derivatives markets, you're innovating in pursuit of efficiency. But one of the other things that happens in exchange-traded derivatives markets, you're always bringing new products, new contracts to the marketplace, and you need to generate liquidity in those. Has your experience of doing that in the derivatives markets taught you some lessons about how to overcome one of the big challenges in say, tokenized securities of generating liquidity?
Yes, I think that again there are parallels in the two that can be adapted, and definitely some of the lessons learned in the derivatives markets, especially in the more customized OTC exotic space, apply to the current DLT markets. If you look at the liquidity spectrum in derivatives, again you go from incredibly liquid exchange traded contracts with central clearing CCPs to OTC bilateral trades that are very much customized, and the liquidity is sometimes exists only because two counterparts are willing to trade. If you look at where we are at in the development of liquidity in DLT-based assets, we are very much on the same on a different scale, but on the same spectrum, where you have relatively liquid assets like cryptocurrency, the top cryptocurrencies, to very customized, if you want, products in the DeFi space, and where the liquidity is expressed in a completely different way from the central order book. In DeFi, strictly speaking, in the liquidity pool, there isn't even a concept of a central order book. It doesn't exist. So when you look at the way OTC derivatives work, exactly the same thing. There is no central order book. Price discovery is carried out in a completely different way. It's more based on price formation, valuation, and the same thing happens in DLT. So I think that there are a lot of lessons that can guide market practitioners when looking at how to structure and develop liquidity in DLT-based securities.
Now, I don't want to make this interview entirely about what's going on in the derivatives markets, but do you see things happening in derivatives markets which are relevant or maybe interesting parallels for what we're trying to do in the securities tokens markets? I'm thinking here of there's been talk of replacing central counterparty clearinghouses, for example, by kind of peer-to-peer collateralization. And you have seen that happening in the DeFi markets. It is, whether it's a good thing or a bad thing, I don't know. It's one of the things which FTX under Sam Bankman-Fried was looking at doing. Do you see developments like that as having legs as we move away from FTX and maybe start to rethink how DeFi will work?
Well, I guess that when we are looking at DeFi and, for example, as you mentioned, collateralization and centralized risk pools as expressed in the CCPs, if you look at DeFi, it runs completely counter to that centralization. It's been built explicitly not to have that collateralization, that central risk pools that are managed centrally by the members, either by mutualizing risk or sharing risk mitigation processes. However, as you mentioned, I think that there are tools in places in the centralized finance world that could benefit the development of if not hybrid models, but at least they could benefit the convergence between DeFi and central TradFi in that respect. And here the operating word is convergence, and we will talk about this probably later in the interview. The FMIs, I think, play a prime role in helping that convergence, and we're seeing that in the FMI world happening via CCPs and CSDs adopting DLT technologies to provide better tools, but also to provide a bridge into the DeFi space. I think that some of these technologies and these techniques and these protocols could help greatly DeFi and DXs to reduce the need for collateral when transacting on a P2P basis. They could help better understanding cross-protocol requirements in terms of margins and collateral. I think that there are some interesting POCs that are being carried out across the industry. Some of them, I think, can really lead the way to shortening collateral chains and facilitate risk compression. So I think that, again, to answer your question, is a convergent process where I think the two worlds will meet.
Mm-hmm. Okay, it sounds like you see efficiency gains to be made in collateral and, well, margin calls in the industry as well, which I'm sure is true. Now, back to the equity markets. You've obviously spent quite a lot of your career in exchanges. You've been at London Stock Exchange and NYSE Euronext, as well as now you're at SIX. Have you brought to SIX, as a result of that experience, a very clear sense of what digital assets are going to do to, or the opportunity they create for traditional exchanges? And I'm thinking here particularly of the fact that traditional exchanges have a problem, which is globally that IPOs are not taking place on the same scale as they used to. Companies are delisting, private equity is on the rise, and even when companies do come to market, they've often, most of the money has been taken off the table already by private equity funds. So they have a problem. They have obviously a great data business, but they do have an issue at the heart of business. Can digital assets transform their situation?
We believe that they can. And the reason is that the market you just described has an issue, which is private markets are always been feeding deals and trades into the public markets. But in terms of infrastructure to support scale and make those markets more accessible, private markets are completely underserved. They are underserved by FMIs in general. There have been very good attempts to to build, curate, grow, and guide private companies and SMEs over the years. You mentioned my two previous employers. They have very good programs to help SME companies to raise capital in financial markets. However, if we look at the detail, they're always feeders programs aimed at ultimately make these companies go public. As I said, the trend is against that, and that has created a lack of support in general from FMIs for private markets and helping investors and entrepreneurs raising capital, and they haven't worked well in reducing the distance between investors and those capital opportunities. So private markets require the infrastructure, and infrastructure has to be equally robust and equally scalable as it is in public markets. And again, we have, in my opinion, jumped a generation of innovation in providing services to private markets. So there are an underserviced segment of capital markets. So now we have this opportunity presented to us as FMIs by the technology, and DLT, almost by coincidence, more than design, provides the possibility to deliver a lot of efficiency and actually provide infrastructure that is robust and also provides the same efficiencies as I was alluding before, expressed as in terms of cost reduction, better user experience, and preservation of margins that the public markets can. Clearly, there are examples already of this that are nearly invisible to us. There are companies that go public now, and you discover that they've been private for 20 years. And those 20 years, something must have happened. They must have raised capital somewhere. They must have reorganized their investors base, reorganized their cap table. They must have issued private bonds, perhaps, or asked for loans. So all that happened on a bilateral, private way, almost. With a very complex chain of intermediaries in between. And yet again, at the end, what you offer to your investor beyond the direct investment in your company is a piece of paper that can't be really used. It's not really bankable in certain terms. It's not part of the classic banking world. Simple things like ownership chains or ownership titles are a nightmare to maintain. Now, it strikes me that a ledger-based technology that relies on very simple encrypted records that can keep that, and where you can embed through smart contracts, for example, which are again an innovation within the DLT, that use smart contracts to automate a lot of the process of the maintenance of these securities, and then make these securities available in the banking system, is a much better mousetrap than what we currently have. So I think that the future is more usage of DLT, and we will see entire life cycle maintenance flows of private equities maintained on DLT systems.
Can I just unravel a lot of what you've said about private markets by asking you this? On the one hand, what you're saying suggests that and this could apply to any stock exchange, not just to SIX, need to restructure their proposition to the private equity industry instead of saying, well, come and cash out your investment by an IPO. You're actually looking to change the proposition to them and saying, well, here is a different technology, a different technique for funding your proposition. So you're offering something slightly different to private equity. And then there's this broader proposition that there are all those private companies out there who may never have taken in private equity capital, may never have thought of an IPO, but are raising capital, as you say, both debt and equity, in forms which are not very liquid and in forms which they can't really use as collateral for anything else. So you're actually entering the private market space at more than one level. If this is bigger than private equity, this is about the whole of the privately managed company sector, right? And on a global scale.
Yes, it is. It is a new proposition. Is not an enhancement of an old way of doing things. As I said, it is about creating an ecosystem for private capital raise. Is about supporting the funding journey of companies. Is about providing also liquidity when needed, without the necessity to go public, providing, for example, support for options or phantom shares reward schemes in companies, in incentive schemes for companies. Is about providing liquidity, for example, for minority investors who want to perhaps monetize their stakes in these private companies, founder investors who want early exits. We are creating all this, and as I say, it's a much larger scale, but also it is a thought through process that guides and supports and curates the fundraising activity, the financing activities of companies, hopefully from pre-seed all the way through to maturity.
Mm-hmm. Okay, well, I'll come back to that very point about process and what you can do to help these companies. But just so I'm absolutely clear here, we're not saying to these privately managed companies, well, you might not want to do an IPO, but why don't you do an STO instead? It's actually much more flexible as a proposition than that. There are lots of different forms of capital raising instrument which the DLT technology makes possible in a way that conventional equity and debt don't, like sharing net profits or revenues, allowing minority groups to take money off the table, and so on. That's really what you're saying, and that's what the SDX focus now on what are popularly called SMEs is, right?
Yes, and I think that it's very important to highlight this, is that what we're trying to do, we're also trying to recycle some tried and tested processes that work perfectly well, but need to be enhanced and made better through the technology, and to create a completely new proposition. For example, one of the things that we are looking at is exactly the format. Our private markets are starting off by doing classical bonds and equity capital, so shares. What the DLT and the DLT law in Switzerland allowed to do is for companies to issue intermediated securities in dematerialized form. And that helps us to take these dematerialized securities, turn them into the equivalent of a share, and digitize them, and deposit them and transfer them, make them available for deposit and transfer on the nodes of our custody and issuer agent members. Mm-hmm. Now, the what you're getting, for all intents and purposes, is a share in a company. But the technology and the wrapper underpinning that technology is a DLT-based artifact, is a cryptographic and encrypted entity that is that sits on a traditional now traditional DLT network. At the moment, we're doing that within our own private chain. We have a walled garden. It's our own private chain that runs on Ethereum, and we have an implementation provided by Corda, for example, to run custody and transfer of these assets on our nodes, and where our members maintain the nodes on the network. Is a permissioned network, but we see that as a one way to start transitioning and start building this world where private companies can tap into further sources of capital for their development. And we're making that journey relatively simple. All they need is an issuer agent, who is one of our members on our network, that will basically fill in what we call an asset definition form, and then create a digital asset that is transferable and settleable on our network. We allow atomic settlement. We allow DVP, or even delivery free of payment of these assets. The issuer agents and the banks involved in transactions decide that. We allow these transactions to be carried out bilaterally among counterparts. But, for example, we ask we maintain processes and checks and balances that you would expect from an exchange. In terms of due diligence run on the issuers, KYC. The KYC is performed by the members on the network on their clients, suitability checks, and all the compliance, regulatory, and legal checks that are required to maintain these assets within a regulated framework.
Now, in terms of making these companies investable in the way that you have described, and you've mentioned that you want to repurpose some of the existing intermediary functions, and that could mean a lot of things, but one of the obvious things is that a company being prepared to go public would work with an investment bank, with brokers, with marketing agents, with lawyers. To what extent can you, as an exchange, get involved in making these private companies more investable, and thereby accelerate the growth of your own business?
Well, when we say making these companies more investable, we participate in the process, and the process itself helps making these companies more attractive to a wider audience of investors, although in a private setting. Distribution, it's easier. As I said, our members are mandated to carry out due diligence on the issuing companies and due diligence on the investors. So KYCs and, as I said before, AML measures are the standardized measures that you would expect in a regulated environment. And those checks and balances, that due diligence, that robustness of process, that is simple and more streamlined by using digital records, in this case tokens on a distributed ledger, makes them more investable. Title chains, again, registrations in commercial registries, all the company records can be easily integrated in the issuance process. by creating digital artifacts. They can be managed through using a token for validation, for example. We can automate through smart contracts the whole chain of checks that need to be performed in a way that is perhaps a lot more dynamic than what you have at the moment, where a lot of these processes are carried out based on some sequential algorithms. The other thing is that the other big advantage of this approach is that once the company is digitized and present on our network, there is no necessity to access a central database where you continuously pull or push information. Every time something happens, an event happens on that security, is automatically propagated throughout the network and visible to all the members of the network. So all of that communication is missing right now. Companies don't have that kind of tool to inform their investors, inform their advisors, inform their issuer agents of any corporate changes, for example. All of that is missing. Now we have better tools, and we will build even better tools in the future to capture all those changes so they can be propagated throughout all the investors. And in my opinion, a company that communicates better and in more consistent way also tends to have better investment success. There is a very high correlation between the way company information, corporate information is propagated to the investors and the success of companies. So we think that possibility to communicate better and more directly with investors through fewer intermediaries makes the companies more attractive and more investable. Clearly, as I said, we can't intervene on more than, but go beyond that, and ultimately the interest, a company is investable in its own merits and in the merits of their business and their idea. But if we can take away a lot of the work that is actually now invested by company founders, by owners, by entrepreneurs in maintaining all that information, in making sure that it's communicated to investors and to intermediaries, if we can take a little bit of that away from them and make the interaction better, then that is all time that can be reinvested in making the company successful.
Mm-hmm. You're also describing a platform or a set of tools which issuers and their advisors can use to do these capital raising exercises at lower cost. What you're not saying is that, yes, we're getting into the corporate advisory business and help make companies more investable. That's not your business. You're just there to provide the platform which those third-party advisors can use on behalf of their clients, or the clients as issuers can use directly themselves. I think you've made that clear, and I hope I'm right to suggest that's what you're saying.
Well, absolutely. I mean, again, and thanks for pointing it out. It's clearly we are not moving into corporate advisory, but we want to fulfill our role as an FMI in making that interaction as smooth as possible. There are also barriers to entry at the moment for advisors and potential intermediaries in some of parts of this interaction because they don't have effective tools to access investment opportunities or investors, because there is no infrastructure to do it. There is no seamless tools to connect to investors. We hope to be able to provide that. But no, our role is to provide the infrastructure and provide this sort of tools to execute this convergence between these two worlds.
Mm-hmm. You mentioned repurposing existing functions. The SDX group itself, for example, has a digital CSD as part of its offering. If we look at the traditional securities markets and how blockchain was meant to disintermediate functions like CSDs, custodian banks, registration, there seems to be some kind of rediscovery that these services are actually useful, not just in the traditional markets, but actually in helping the securities markets to grow. To be specific, do you think that having an independent registrar, for example, will encourage more issuers to come and more investors to come to a digitized asset market?
We do. We think that share registry companies and share registrars and companies using DLT technology to digitize share registry and corporate governance, the maintenance and execution of corporate actions have a very important role to play, because, as I said, there'll be points where these kind of actions might be centralized. We don't know yet, but surely there is an indication at the moment that share registrars will fulfill a lot of those functions. We have partnerships with fintech companies providing DLT-based share registries. We are building, one of the things we are doing, we are building a connectivity for them to contribute and get data from our platforms, but also link straight into our custody systems. We are looking at solutions that will allow issuers to elect a share registry, a DLT-based share registry that is linked to our CSD members as their share registry service, and that will cascade the information from the issuer all the way down to the depository bank. The records will be transfers will be automatically updated, and then all that information will flow back into the share registry, and as a consequence will be in real time queryable by the company itself, and all the advisors of the company will have access to that. So the company has an up-to-date picture of its share registry at every time, and that, as you know, helps a lot of other downstream processes. And also the big advantage here is that we are trying to remove and automate the update of these records by the depository banks or by the investors themselves, so not to force them to have a manual message going through to the share registry company or the company directly, that then has to update the records in the share registry. So we are trying to remove all that and to automate the process so that it draws from one center of trust. So when the record changes, the same principle of the digital ledger that we operate applies externally. All the records within the share registry are updated. Mm-hmm. So yes, we think that external share registry companies play a very important role, and this is one of the services that we are looking to automate. We are on the way. I think that we should be able to push out at least the first version of that automation next, or partial automation next year.
So registrars continue, but not in the way that we have come to know and love. You mentioned partnerships, and you've formed quite a few of these, and I'd like to explore how those relationships work with you. Perhaps we could start with the partnership you have with Daura and the Berner Kantonalbank. Now, I assume that BKB brings a kind of client flow. Daura sounded to me, or the services they provide sounded to me very comparable to what the DTCC is trying to do with its digital securities management platform that it's building for the privately managed asset markets. Am I right to describe those functions to BKB and to Daura, and how do the partnerships work in practice, whether I've got it right or not?
Well, the roles are distinct, but they sort of overlap in certain areas, and BKB is joining SDX as a member. So as a member of the exchange, they will act in their capacity as issuer agents, depositary, and payment agent. They can elect to perform the three functions within our.
So I had that wrong. They're not bringing clients from their canton to the marketplace. They're actually providing services.
They are providing services on our platform. Then, as you know, BKB has a fairly important presence already in private markets. They have two platforms, two OTFs out there, where they maintain markets in private equities, in privately held companies, not non-listed companies, and on structured products. So in a way, they are providing secondary liquidity for these issues. And one of the possibilities is that at a later stage of the development of the relationship, these platforms might be linked into our CSD. So the settlement of some of these private companies will elect to issue digital securities within our exchange can be performed on our CSD. So all the secondary liquidity, all the trades on the secondary market could then be settled on our CSD. But that is one of the possibilities going forward. At the moment, Berner Cantonal Bank is clearly interested in leveraging their position in private markets to help new companies issuing private equities in digitized form,
okay.
and be part of that market in providing further services down the road. Daura, as you described, is basically a fintech, a very smart fintech that provides, among other things, share registries, custody of DLT securities, and pure tokenization. They work very closely with BKB, so they provide a bridge from their DLT securities into the banking world, and the plan is clearly to make some of these DLT-based securities bankable by bringing them into our CSD. So it's a way for us to load our platform with new assets. So the cooperation is based on those terms.
Now, you've also got these partnerships with Equitech and Actionariat. I noticed that Equitech in particular helped F10 in that private placement that of tokenized shares in SDX as a digital CSD. They helped in that transaction. So how do those two relationships work with Equitech and Actionariat? What are you getting out of them?
Well, again,
and they're getting out of you as well, of course.
So the role of Equitech in that transaction was to provide DLT-based share registry for F10. So
just what you were describing earlier, then.
Yes, the role I was describing earlier. So they are one of our partners, and they are providing share registry for F10. At the moment, the process is still not automated, but that's exactly the spirit of the partnership, is that we are driving together to deliver that automation I was describing before next year. Actionariat the partnership is also along the same lines. Actionariat provides share registry. They provide their own secondary liquidity to the companies that issue DLT-based securities on their platform. What we are looking to do is to build the optionality for their issuers and investors to take those DLT-based securities and transform them into intermediated uncertificated securities on our network, so they can be settled by the banking system and can be settled. And that the advantage for the investors is that in that case they wouldn't have to maintain a separate custody wallet or custody place. They can use their bank account, the banking account, and their deposit account, security deposit account with their bank.
Just as they would if they had an account with SDX as a CSD.
Yeah, they would have to. They would have to be client of one of the banks who are on our network as member. But again, we cover about 90% of the Swiss banking clients. Our members are, as you know, Credit Suisse, UBS, Zürcher Kantonalbank, BKB, and CM Equities. Investors and retail clients would normally have, one would hope, an account with one of these banks. If they don't, I can only urge them to ask their banks to become members of SDX.
But to be clear here, it sounds as if this relationship makes it more convenient and more familiar for the more conservative, more established financial institutions to get involved in this market, because they can go through a banking system and a CSD account system that they are familiar with, right?
Correct. That, again, this is about the convergence I was talking about.
You mentioned convergence.
Is this way to provide for tried and tested processes that people are familiar with, but providing them with a new technology engine. And we want that engine to be completely invisible, by the way. The user experience has to be either enhanced or being as equally as good as what they have now. The gains for the users is exactly that, is that there is a certain familiarity, there is a certain consistency in the processes as they are now. So in the case of Actionariat, as I said, this would be one of the options that they would provide to their issuers and to their clients. And again, I think that for companies like Actionariat, what that represents is a way to expand reach, and for the companies who issue with Actionariat, expand the investors base. For the banks, expands if you want, the addressable market in a way that doesn't force them to take massive jumps away from established processes, and also take risks in a way, in terms of or excessive risks in a way of entering new markets. They can use our processes to start going into that direction without too much risk. And the thing is that the banks still control that process, because, as I said before, KYC, AML, due diligence is still reflected by them in the process of accepting an investor or accepting an issuer.
On that question of convergence, and I'm talking here at a high strategic level, SIX has obviously invested heavily in building these digital asset capabilities. But its view could have been, we kind of need to hedge our bets, because what if digital assets overtake our traditional securities business? We'll have this thing, and we'll be in a good position to survive any disruption it's caused. Well, they could take the view that this gives us access to a whole lot of new assets, new markets, and therefore we'll be able to grow our business alongside our traditional business. Or they could take the view that at some point over some period of time and in the future, these two markets are going to converge. Do you think that's the strategic bet which SIX has now placed, is actually the digital asset and traditional asset markets are going over time to converge?
Well, I guess the strategic bet was is another one. Clearly, is the fact that these digital technologies are going to change the way FMI operates. They present clear and tangible benefits for investors and for and in general for any users of financial markets, from payment services all the way down to investments, and that the group could wait and do nothing, and be then forced by his clients or market dynamics or simple economic circumstances to go into these new technologies and adopt these new technologies, or they could decide to take the lead and shape this change. So this is what across the group has changed the thinking, and the expression of that at group level is SDX, but also a lot of other initiatives that connect into these new technologies across data, payment services, and so on and so forth. Now, if we bring that down to our level where we operate in terms of capital markets, I sound like a broken record. Convergence is the key word here. We are realizing that, and I made examples, there are processes that are perfectly good and work perfectly well, but can be enhanced and can be used to provide better user experiences if enhanced with these technologies. There is also another aspect that is more important and is more long-term and is more where the vision is going, is that public blockchain, DeFi, decentralized exchanges are not going to go away. But they need the expertise, the processes, the familiarity that traditional financial players, and more specifically FMIs, have with providing consistent processes, with providing trust, with providing regulated environments, in responding to governance and compliance frameworks, in centralizing some of these processes. By the same time, we recognize that we need the technology that is being developed in DeFi. We are confronted with new thinking that we cannot ignore. So we either help that transition and provide the right tools, and we lead and we shape this narrative, or otherwise, I think we're going to be submerged by it as FMIs. But also, again, it speaks to our historical role. FMIs are there for a reason, to provide infrastructure for financial markets. There just happens to be new financial markets that will be catering in a different way for different needs in the future that we simply cannot ignore. Mm-hmm. But the two cannot live in isolation. They cannot live they can even coexist. I think that they will need to come together. And again, we are there to provide that, to help that transition in both ways.
If you used the words lead and shape there, as well as talking about convergence, and as you look forward, in the way in which the strategy will unfold over time, if you like, is SDX here orchestrating that change? It's building this ecosystem. You've got these partnerships. You believe that these existing intermediary functions will survive, albeit in altered forms. So is the vision here ultimately a kind of networked industry in which SDX is a part, or is it going to be a network which SDX is itself building and creating this? I think network is the right word. I could use the word ecosystem. But does SDX become part of a wider network, or does it shape and lead a network of its own and bring along all these other forces and players as a result of these powerful secular forces which you've described very articulately, about technology, about the decline of IPOs, the need for private companies to access new forms of capital ways and finance their businesses in new ways. These are all powerful forces to which you're responding. To what extent can this network be your creation as opposed to you being simply part of it?
Well,
sorry, it's a very long and complicated question there. But
you're asking me to gaze in my crystal ball.
Yes, yeah.
So it's a very I think that we are discovering new things all the time, and that is what is exciting of being involved in capital markets at the moment, and is a very exciting moment because we are restarted discovering new things and new ways of doing things. I think that if we look at the world at the moment, chances are that not only SDX but FMIs in general will be part of a vast network. And but they will have, in my opinion, a very important role to play in shaping and influencing the way that network works. There are functions that can be centralized or will have to be centralized on that network. Things like, who owns the trust, who permissions certain actions and certain functions, who will make sure that certain compliance permissions, certain regulatory rules are respected. That will probably need to be centralized. They won't be decentralized across the network. So you will probably need these centers of trust that still exist. And I think that FMIs will be that, and they will provide the infrastructure to the rest of the network to carry out that function. Mm-hmm. So we can see already some areas where FMIs will provide, will be a node in that network, and they will provide some centralized functions. The other, if you extrapolate for that, you can think of a future where there will be a necessity perhaps to provide some sort of sub-networked settlement or clearing functions that cannot be relied upon in peer-to-peer exchanges in bilateral transactions, that need to be still centralized and performed by a center of trust. Then if you look at what comes before that is liquidities, transactions. Where does that liquidity takes place? Can FMIs help that liquidity developing, or is that liquidity better served by the network itself, free and unconstrained to develop that liquidity as they want and as they wish? And exchanges will perform only post-trade, what we call now traditional post-trade functions. I'm sure they will be different. Will the exchanges maintain ledgers where specific transactions are validated or permissioned? So to answer your question, we think that FMIs in general will become nodes in that network. Then, as you know, not all nodes are created equal. Some nodes are larger, some nodes are smaller. Some nodes will perhaps provide specific services, but I think it's going to be we're going to be part of a wider network.
Mm-hmm. Just back on planet Earth, are there concrete synergies now between what SDX does and what 6SIS does? Or do you, at this present, operate mainly in separate silos?
Well, at the moment, we operate in separate silos. As you know, SDX is an independent entity within the group. We have our own separate regulatory license with FINMA. So we are regulated, our CSD and our markets are regulated separately from SIX as a separate exchange. Then clearly internal, there are a lot of synergies that we can leverage on that are being built with the traditional world or with the rest of the group. Certainly, we are learning a lot, and a lot of these lessons are clearly being leveraged upon by the rest of the group. Also, I would like to point out that the activity, the blockchain technology DLT activity of the group is not only confined to SDX within the group. There are other areas and other divisions who are looking at these technologies and are already using and building services based on these technologies. But I think that different centers of knowledge and skills and competence within the group slowly are trying to get together and they will certainly leverage on each other.
Can I ask you a very basic question now about how you go about finding issuers? You've touched on this in a number of ways, and you've certainly described very clearly how the services you provide help to cut the costs of raising capital, and you've described very clearly how that doesn't necessarily mean disintermediating all the functions of the traditional securities markets. I've noticed you're working with CM Equity, which is I think I'm right to say, as a German introducing broker or corporate advisor with a speciality in the digital asset area. Is relationships like that how you think you're going to find the deal flow, if you like, of issuers going forward?
Well, at the moment, yes, we are relying on external counterparts, to provide the deal flow of issuers. We want to enhance that. We want to have more partners that can potentially provide flow into our platform. However, as you know, and that's a lesson from the old world, exchanges across the piece are fairly active in scouting and selling their issuance services and their primary markets to issuers directly. The London Stock Exchange is, for example, an example of that, and other exchanges do too. Are we gonna start down the same route? Possible. If we see a benefit for the whole ecosystem and for the community of us being more active in marketing in marketing directly to issuers, which is something that we already do in a sense, but in a very restricted and very small way. Whether we're going to go into that, it's a possibility. We would certainly do it though with our partners and with our members.
Mm-hmm. And those issuers are impressed when you talk to them by the possibility of cutting the costs of capital, I'm sure. Correct me if I'm wrong, whether that argument is failing to land, I'd be interested to know. But how much do they care about other things like custody, by which I mean the servicing of the assets, the payment of dividends to their investors? How much do they care about secondary market trading, the place where the price is put on their instruments? How much do they care about those things as opposed to simply getting cheaper capital?
There are the asset servicing part of it is becoming more and more important, because they do realize that it's a cost. It's a cost that they have to maintain long term. It's a recurrent cost that they have. In terms of the secondary market, it's interesting. Some issuers want or would like to have a secondary market on their shares. Some founders, and very recently we spoke to a couple of them, go like, why would I want a secondary market on the shares of my company? It's not in my interest. It's not in the interest of the company. It's not in the interest of the other shareholders. We don't think it's a requirement for us. All the founders we talk to and we do research with seem to indicate that they like the principle of secondary liquidity, but they like also the idea that they can control that liquidity one way or the other. So in a sense, for example, they can potentially whitelist investors that can transact on the shares. They can agree with the boards in terms of access to those secondary markets. They can, for example, create specific liquidity events for their shares. So I think that there is, to answer your question, there is a more heightened awareness of the benefits of the asset maintenance piece. And there seems to be a consensus that it is something that we need to address, because it makes a difference in terms of cost, because a lot of that cost is sometimes embedded in fundraising. So there is a cost associated to that long term. In the secondary market, it's less clear. It's less clear. Some issuers see it as a massive benefit. Some of them like a nice to have, and some of them are completely against it because they think it's a distraction.
Mm-hmm. Now, you need investors as well. And how much do they care about secondary market liquidity and custody? How important, how valuable is it to them to know that they can sell what they're holding, the liquidity is there, and that they can be confident those assets are being kept safely, and yes, their dividends, when they're paid, will be paid on time? Well, is there a clash of interests here between issuers and investors?
When you ask, well, 80% of investors want secondary liquidity. However, when you drop down and you drill down exactly on what they mean with secondary liquidity, you will notice that they have, they don't all mean, oh, we want a central order book where we can transact. A small percentage of investors don't care, because they say, we invest long term in these companies. We have a close enough relationship with the founders and with the boards of these companies, so we can create our own liquidity when it's needed. But also there is, again, it depends it depends the type of investors. Investors that are the classical VC investors that invest long term. They're not too too bothered to have regular secondary liquidity. They say, as long as I have an efficient way for my exit that doesn't force the company I invested in to go public, then it's fine with me. But I certainly don't need a continuous auction-based central order book to support my investment, because we just don't invest like that.
Right. And how important, you're obviously growing this business, it's founded in Switzerland, it's growing in Switzerland. How important in creating this relatively mature digital asset market in Switzerland has been the developments in Swiss law? Do you think that SDX could be doing what it's doing without that legal underpinning?
Well, DLT law has changed corporate law, if you want, in Switzerland more than financial markets law or regulatory. So I think that it has enabled for us, the law has enabled the possibility for us to offer new services, such as a regulated exchange-based market for digital securities. The law has brought about changes in the way companies can issue shares and the type of shares they can issue, and also has provided a rail for the recognition of DLT securities. That has then caused a change in the code of obligations of these companies. That is really the key element of the legislation that enables the possibility to issue equity or debt, sometimes in digitized format. Mm-hmm. So I guess that to answer your question, it has enabled a lot of the things we do, mm-hmm. And also it has enabled the design of new actors, such as DLT share registries and things like that, to come into the marketplace.
Have you been able to size this opportunity, by which I mean this focus on privately managed companies, for example, either size it in Switzerland or Europe or indeed the world, or would that be a fool's errand?
No, we have sized the market opportunity. Although it is difficult, it doesn't make it a fool's errand. It doesn't make it a complete pointless exercise. Actually, quite the contrary. But it is difficult to frame the data you get, and also the context in which you interpret that data. However, just a few data points for the Swiss market, and we are very focused on the Swiss market because we want to learn to walk before we run. And in Switzerland last year, there were recorded officially 350 funding rounds carried out in the private markets. We, as an exchange, a traditional exchange or now digital exchange in operation for exactly 12 months, have seen the grand total of 0 of those funding rounds. So that is our baseline. These are the officially recorded funding rounds in several public publications and databases. And these are mostly confined to seed and Series A's and B's. On top of that, we have all the funding and capital raise activity of more mature SMEs that are using private capital for growth or banking facilities, loans for short and medium term capital. That is data that is more difficult to get, but we think is it runs in tens of thousands of transactions every year in Switzerland only. So there is in Switzerland only a substantial addressable market for us. We are very conservative on our estimates. For us, success would be start capturing on a regular basis part of these early stage funding rounds.
I have one final question for you, Massimo. It's a high level one, I suppose. If we look at what's happened in the cryptocurrency markets since November last year, it's been a rather sorry story, culminating in the collapse of FTX, which has shaken confidence in those markets to a degree previous events seem not to have done. Yet last week we heard, the chief executive of BlackRock, Larry Fink, say that the next generation for markets, the next generation for securities, will be tokenization of securities. So is it safe to say that the blockchain technology, in the instance of tokenizing securities or other types of financial instruments, has successfully decoupled itself from the cryptocurrency markets? It now has an independent existence and will succeed or fail on its own terms and have nothing to do with what's happening in the cryptocurrency markets. Is that the point we've reached?
Yes, I think we are at that point. I think that what we've witnessed in the last 4 or 5 weeks points to a view that the technology is a separated item in this discussion. If you look at the failures of FTX, it's a very traditional failure if you look at it, based on leverage, poor governance, poor controls, poor checks and balances. The list is very long, and certainly it's been widely reported upon. I don't think that has tarnished the value proposition of the technology, but more importantly, has tarnished the value proposition of building an ecosystem around these assets. So I think that, yes, we are at a point where now the two things have been decoupled, and where the technology is being seen and considered on its own merits and on the advantages and the promises that it holds for the future.
That's a great point to end on. Massimo Butti, thank you very much for taking so much time to share with us your knowledge and your insights, and indeed your prognostications for the future. Thank you.